All right. Good morning, everybody. Hopefully you all had a chance to participate in that. It's pretty nice to get month done when it's only the 5th day. Living the dream. All right, the founder's note came out right before I started, so I didn't get a chance to read it yet. It's very likely that you guys will know more about what is in it before I do, since I'm streaming right now. I did get a chance to see the spot gamma index, which is at minus 3.3. It only goes to minus 4. So when we're thinking about how that stacks up, we're about as negative on the gamma index as we can get. The gamma index is a useful tool to try to decide or define what a breakout should do today. If it's a positive 4, breakouts should fail. So you would want to buy any breakdown and sell any breakout. At a negative 4, you would want to sell every breakdown and buy every breakout. And we're at a minus 3.3. So that's pretty negative. It implies that the market could really grow legs and move. And well, we've seen that all night. Markets are down around the world for the most part. Japan sticks out in a positive 3.2. Hong Kong basically flat. The Dow down 2%. Europe down 2.5%. S&P close to 3%. It's a shocking number. Tech down more than 4.25%, and small caps down more than 4.75%. Impressive numbers. There's been times where we've seen these sorts of moves and we end up with a capitulation low, like a V bottom bounce, and a sharp rally in the other direction. I'm not saying that we're going to get that. I am saying you want to be prepared for that. One of the things that triggered all of this is a bad jobs report. And we always get headline numbers, and then when nobody's looking, we get revision numbers. That's one thing to be watching for, is those revision numbers. Another one is the Fed doesn't have to do something. A lot of times they just have to talk about something, and the markets will start pricing it in as if it's already happened. The market is pricing in a rate cut as if we've already got the cut. Well, now the Fed doesn't have to cut because the market has already priced in these cuts as if it already happened, doing the job of the Fed for them. That doesn't mean it'll solve the problem, but I've already seen, a couple of analysts saying this is going to force the Fed's hand and make them cut. Well, the market's throwing a temper tantrum, and if the Fed does an emergency rate cut, it will validate this temper tantrum. The market is saying the Fed is too late. They're behind the curve, that, no matter what happens now, things are going to spiral out of control, and they're pricing that in. The Fed is arguing that they're not. And if they do that emergency hike, then they will be telling the market, yep, you're right, we were wrong. So we'll see, right? It's a waiting game at this point. We got PMI services at 9:45, and at the moment, they're not yet hedging that. There's no market maker move, but it's not an 8:30 print like we normally would get in the mornings. Hedging, we'd see a market maker move before an 8:30 print. Well, it's 9:45, so maybe we're not seeing the market maker move because they still have time. I don't really like that suggestion, but I mean, it's got to be put out there, right? It's maybe we're not seeing it because, well, they have time and they're not in a rush to put it on. you want to continue to watch through the morning for a market maker move, because that would tell us that they are gearing up for a surprise on the PMI numbers, when at the moment it doesn't seem that they are. We're going to get some additional auctions today. So 3-month, 6-month, we got 1130 is what's listed here. But as I've said before, not everything gets listed on these pages. And if you have auctions anywhere, if they're at 1 or 11 or 1130, just assume that you have auctions in all 3 places. It says today we got auctions at 1130. I would surmise there's also auctions at 11 and at 1. The loan officer survey shouldn't be impactful. I'm going to leave it as shouldn't. They are showing it with mid-range. We'll see. I don't want to take it off the table, and I'm just going to leave it out there as they've got it as a mid-range when it comes to impact in the market. I'm a big fan of just telling people to watch the clock. What time of day it is one of the best indicators that you can use as a day trader. So don't get caught, with a tight stop at 2 o'clock when we get a little bit of volatility and maybe a little whiplash in the market. Other than that, it will get us through our day. Dali's going to be speaking after the market is closed. That won't really be of any consequence to us today. I was listening to Bloomberg this morning, and they were talking to, I don't know, some fund I didn't catch the name of. And they asked the person right before they signed off, so in this kind of environment, what are you telling your investors? What should you have people focus on? And he said, yeah, long gold is probably still good. I can't believe they let him get away with stuff like that. You saw that move Friday in gold. If you didn't, it was impressive. If you remember during COVID, when volatility increases, how much collateral you have becomes more relevant. The banks are going to want more, or the trading desks are going to want more. You can get a margin call when they increase the amount of margin required. And when you're upside down, you got to put it in there. That happens to everybody, even the big funds. And those big funds sold their gold during COVID because they were getting margin calls. And I remember that time frame really well. If you were trading back then, it was something that I was pointing out in a big way back then, right? It was really something that at the time I was completely shocked at that. This is supposed to be a safe haven, right? When times of uncertainty and crisis, going to gold is what makes sense. And so when it sold off back in COVID, I dug into that a lot. That was a margin call. I know it has been, hadn't it? Yeah, you've been around a long time too. The we got that sharp move Friday, right? Like around noon. Gold just dumped like a brick in water. So, this fund just off the cuff saying something like that on Bloomberg, I don't know, it just hit me the wrong way. I'm not a licensed fund manager. I'm not managing other people's accounts. But even I'm paying attention to what's going on and wouldn't tell people to take their long-term portfolios and grab a hold of gold. It just frustrates me to no end. The move-in bond is not just a flight to safety. It's more than that, right? It's that's a good part of it. And we've been hearing quite a bit about that, but we've been seeing the move before then, right? It's been working its way off since the May lows. It's been just working on that grind, higher highs and higher lows. So it's more exacerbated now, certainly, but that's not the only reason, right? And there's a historical precedent to what happens to the markets when the Fed finally officially announces a cut. That's something to keep in the forefront of your minds too, that there is precedent to how the market behaves when the Fed actually does officially announce that cut. For the most part, once we're done with ISM services, we're going to pretty much be done with the known news today. These auctions, I always pay attention to the auctions. Sometimes it feels like I'm the only one. And these are way up front, so they're not expected to be the highly impactful. It's not like we have the 10 or the 20 here or the 30, but I wouldn't dismiss these auctions. I never do, and I wouldn't start today. And for this loan officer survey, I mean, it's a survey, right? It shouldn't have much impact, but they do have it ranked at mid, so I won't dismiss that either. So it's going to be a day where we want to constantly monitor something like finance juice. Keep our eye on the news that's coming in, because we've got multiple opportunities throughout the day to see a dynamic shift in market structure. Yeah, it's that sort of move from Robinhood that made it where I really quit trading there. For a long time, that was my go-to when I was running multiple leg trades like butterflies and iron condors, just to save up on the commissions a little bit. But that continued manipulation from them is why I really um, don't trade much there anymore. I've got a little bit on Robinhood, sure, but I, I tend to just stay away from them now. All right, where the cloud is, that's the weekly pivot point. We tend to keep focus on how far away from the weekly pivot point we are, because there's this, I don't like saying overbought and oversold, but there's this distance that we get where the market has had just about as much as it can take and will stall out there and or will mean revert there. We've seen it time and time again. And one thing that sticks in my mind are those weeks when we open far away from that weekly pivot to begin with. Sure, we can get a little farther away, but it takes a lot of push to do that when you opened already a considerable distance away from the weekly pivot. So when things are positive, we can open far away from that pivot, but we don't generally see too much push unless we get some news that goes with it. Well, it can go the other way too. We got really far away last week. If it hadn't been the end of the week, we probably would have had some sort of mean reversion, but the week ended, so we never had a chance to flip it back the other direction. The new week began, we continued that stretch to the downside. How far away we get from this thing, I've tried to quantify, built indicators that measured it, tried to find a common kind of turning point, and that failed miserably. So I don't have a great distance on how far is too far when it comes to this tool. But it is something that I watch. When we get, quote, too far from that pivot, I expect price to pause, consolidate, and or reverse and go back the other direction. We've seen it time and time again, even in the worst of circumstances or in the most bullish positive circumstances, that we can only get so far away from that line before the market just can't go anymore. And the analogy that I would give would be a runner trying to run up a hill, and we just keep stacking more weight on his back. Sure, it can continue to run, but it's going to be harder and harder with each step. Somebody gave me an analogy on a tractor pull the other day. You know, you have your starting point, and the farther away you get from the starting point, the more difficult the weight is. All right, so that you can pull, 20 yards, but each yard you go is more difficult than the previous one. Something to think about when we get distance analogy and trying to figure out how far from this thing can we go. It can go as far as it wants. It's price, right? Never want to say that price can't do something. Every time we've tried to say something like that, it always proves us wrong. Price can do whatever it wants. But the likelihood of a continued drive farther away from this line at some point gets to be, like the question of what's more likely. We're going to leg down yet again one more time, or we're going to pause and mean revert. We're at 5,200. It's a significant structural level. We're a considerable distance from this floor pivot, and it's very likely that we're going to base, pause, consolidate, and or mean revert back in the other direction. That wouldn't turn the market bullish, right? I'm not saying anything like that. But after a market makes a move, it pulls back, right? Makes another move, and then it pulls back. Then it may digest for a while, may even try to set some higher highs and some higher lows. But once the move begins again, we're yet looking for another pullback. So it's just common market structure. In good times, markets structure is a lot easier to see. Most technical analysis is based on markets behaving. When they start misbehaving, moving a lot farther than they should, a lot faster than they should, a lot of technical analysis goes right out the window because it wasn't designed for that. That's what frustrates new traders the most. They're looking for answers, and they get answers like, don't know. Can't mark out levels on a parabolic market. And they believe that, technical analysis should work all the time. And unfortunately, that's not true. Looking at the ADRs, we're already below the low end. We don't have a market maker move yet to stack onto this, but one easy way of trying to define the next levels lower is to just measure a distance between these two and stack them out. You can do that with your fib levels as well, or you got the quadrant tool. You can use that. I've seen some suggestions of this, and I've kind of played around with it a little bit. I'm not ready to adopt it yet myself. I think just drawing a box gets it done for me. But we've got one level there. And if you want the second level, you can just run from red line to red line. And say you can stack that out, right? So I think I put this one in the wrong spot. Yeah, measure this, stack it out. It would be there. That would be your full length right there. So it's basically just doubling this one. Up at the top here, we've got a daily one standard deviation of 167. There's another way to get standard deviation on Thinkorswim. Go to the trade tab, and it doesn't matter what you grab, just grab something so you can throw it into the risk profile. So I'm just gonna buy a single call here. Just need something down here so that we can right click on it and analyze trade. That'll open up this, which is the risk profile. So we want to set this up here to 8.6 because this option would expire tomorrow. This gray area is a one standard deviation range. Stick with me here. There's a method to my madness. Up at the top, you can change that to a 2 standard deviation range. You can now set the slices to a 2 standard. You didn't need to change the probability range. It just helps with the visual. These two lines are called price slices, and we can look at those and go put them on the chart, or you can just click down here, put those slices on a chart. This is one of those. 54.84 to the upside. 49.19 to the downside. That's a 2 standard deviation move from our current location, not from the close of last week, but from where we're at right this minute. Now, if you don't want to lose those lines, save them by changing their name. When you go back to the Analyze tab, you can set these slices now at a 1 standard deviation. And again, you don't need the visual, but if you want it, put it back to a 1. Set those on a chart. There's your 1 standard deviation. We could do a 3, but it's been a long time since the ES and the NASDAQ did, 3, 4, and 5 standard deviation moves. There's a 95% chance that price will stay inside the 2 SD range. There's a 68 point blah, blah decimals that it'll stay inside the 1 SD range. It's just math, right? All right, so looking at the weekly, we're really close to the 50 week. We're under the 10 and the 20 week. The cumulative volume index is back to the center of the Bollinger Bands. It's underneath the 10, the 20, the 50. Cumulative volume really sold off in the NASDAQ last week after aggressively pushing, right, that's stretching that band higher. We're at the 200-day. Now there's two 200-day moving averages here. One is the EMA, the other is the SMA. I don't distinguish between the two to show people that they're both going to matter, right? Or they're both not going to matter, whichever the case may be. There's no reason to try to struggle with, should I have one or should I have the other? I just put them both on, solve the problem. We're hitting one of them. Just like when we hit the 50 for the first time, when we hit the 200 for the first time, it's very likely that there'll be a market reaction. We're likely to bounce, pause, consolidate. If you want to see that 200 on the intraday, there is a moving average for that. Even on TradingView, you have this possibility. Just type in the word daily. You'll get a daily SMA. It doesn't have to be a daily. It's just called daily. If you load it, once you open it, you can choose what you want, days, weeks, whatever. This is the SMA, and it's all that Thinkorswim has by default. But I built an EMA that functions exactly like this. You can get that from the Thinkorswim workbook. So here we've got the daily 200 on the chart. There's the SMA, there's the EMA. In TradingView, it's the same thing. Just load an the basic standard EMA, and it has a multiple time frame component on it. Tell it you want the daily. For the most part, VWAP's been keeping up with us relatively well. We did break down out of this last structure, which, I don't know, I kind of liked this breakdown for a reversal, right? One last hurrah, a little bit more to the downside. It broke that 200, that's 5,200. It broke that level. I like everything about it for a move back up. But in this move back up, we're not talking about even getting back to Friday's close. You know, if we got that much, I would be surprised, really. But what I'm not expecting is a continued sell-off into, say, 51 today, or even 51.50 today. Markets really just are only supposed to go so far. And unless things come out today in the economic data that is even worse than what we've already got, then it's very likely we're going to pause here, maybe get that mean reversion like a dead cat bounce and come back up the other direction. But we're not talking about some, you know, rally into 54 and 54.50 and that sort of thing. We'll be lucky to even get back into 53.25 area, right? Which would be, say, this 53.31 cog line. Isn't that interesting how we got a cog line out of those standard deviation levels? Yeah. Most platforms now have a year-to-date VWAP. On Thinkorswim, because of the contract change for the ES, it's off, right? So just use the regular one here. You can see how it's not connected. Because of the contract changes. So it's showing that we're hitting it, but it's just janky, right? It's off. So I would recommend going to a different product, say SPY, right? Can't do it for the SPX on Thinkorswim because Thinkorswim won't show VWAP for SPX because, well, it's a volume and SPX doesn't have volume. TradingView will do it for the SPX, and it might do it for the ES without that janky, weird. It would be the blue line. There's your year-to-date VWAP. I remember looking at this Friday and it had increased sharply. So that increase is right. If I still had this as a line rather than dots, you would see that line go up sharply from last week. It's right. It belongs up there. So that's not a misprint. If you went through Brian Shannon's book on anchored VWAPs, he talks about how very sharp moves like this can happen. That's one of the reasons that I feel that this is still valid. But the one on Thinkorswim is just all janky. So, you know, it is what it is. We're underneath it. It's the volume profile for the week last week. We don't have a good structure, like a common structure. A D shape, a P, lowercase b, double D. We don't have that structure. This is just a lot of nastiness. Let's get back on the ES. But 5350, as if we didn't already know, is going to be a significant level to get through. It's going to be an options level, but it's also a high volume node from last week. So any move to the upside, we're going to have to deal with that. We're underneath one of the major voodoo lines, the green one. We cut through it last week, or last night, I should say. It's easier to see when we get it out here a little bit more. This is the 3-day door. It's kind of I think that's the biggest 3-day door I've seen on this, but I wasn't using the door back in COVID. So, you know, could there possibly be a day, you know, a 3-day back there? Yeah, maybe. In March when we were on our way back up, possibly, right? But that's a big door. We're still above the 10-month. There's the voodoo lines I was looking for. We're on a daily with these voodoo lines. These are made for the daily, and they're just easier to see when you put them on the daily, but they're the same ones we were looking at on the lower time frame. There's nothing else around to the downside except this snow line at 50.74. It's a long ways off. Volatility increased significantly. It's not a surprise, right? Primary and secondary trend on the MACD are both bearish. So we're lining up across the board. It's looking like every tool that we have is pretty negative, but I'll continue to stress that we're supposed to get X amount of a pullback and then that's it. Well, we've exceeded that, right? Because put the label on here. That's a 9.3% pullback. And if we were looking for, you know, like a 5 to 7, well, we've got that. Some technical analysis out there says that once we've expanded more than 10% away from our high, that we are officially in correction territory. It's one of the reasons why you're hearing that the NASDAQ is in correction, since it exceeded that level. %17 move off of the high. Now, other textbooks will say that you need a 20% pullback before you're officially in correction territory. I would say that all of that is a simple off the cuff answer, but it's not a perfect answer by any means, no matter which one of those numbers you use. How fast we get there is a real big deal to me. It's the rate of change, right? How fast we got up and then how fast we came back down. These yellow lines are previous month levels. They're supposed to be, these look like weeks. Hold on. Yeah, they're month. So there's July, and we're outside of July's level, right? Then there's June's level, and we've broke that. I know it's a little weird, but here's June, right? So June ended, plot the lines across. July broke out of June's high for a while, then came back inside the line. Now now July is ended, so we plot that forward. Price is broken out of July's range to the downside. So we got an inside day breakout, inside month breakout, let's say it that way. Still no market maker move yet. Now, for any move today to the upside, which it's possible we could get, right? We could get a move to the upside. Yeah, I thought I updated that. It's not showing. Here's our put wall, 53.28. So any move to the upside today is going to have to fight through all of these options levels, including that put wall. Because we're in zero gamma, or we're under zero gamma, we're in negative gamma, the market makers are going to sell into the selling to try to balance their portfolios back into a neutral delta state. And I'm sure a lot of you who don't trade options have no idea what I'm talking about. But the main thing is looking for a V bottom, looking for, a rug pull and the market to come in and play save a hoe and run this thing back up. That's what happens when we're in a positive gamma environment. When we're in a positive gamma environment and we fall, market makers are buying into that fall to balance their risk, right? And since they're buying as we fall, it slows the fall down and helps us get those V bottom days. But when we're in negative gamma and we fall, they don't buy into that fall. They sell into the fall, and it aggravates the fall and makes the fall worse. And it makes us pick up speed, and we can accelerate to the downside really fast because they're selling, CTAs are selling, VC funds are selling, everybody's selling. Nobody's taking the other side of the play. And if everybody is scrambling to do one thing, whether it's go up or go down, then the markets will make that move really fast. It's already exceeded how far it should move with basic normal technical analysis, which tells us not to look for things like SD levels, floor pivot levels, ADR levels. The market doesn't care about those at this point. It's already exceeded all of those. And it's going to take something beyond a simple measured move to make the market stop falling at this point. 10-day, 30-minute volume profile. We need to stay in one point long enough to build up volume. And where the point of control is right now, we won't even get into those candles until at least Wednesday or Thursday. So we're not going to decrease the structure of the profile and that point of control until at least Wednesday. And we're not going to gather volume up anywhere else fast enough to move it. So that point of control is just going to stay where it is, right around that 5,500 area, at least until the middle of the week. Once we start to decrease that volume through the middle of that structure, it's very likely going to end up at 53.75, because these up here will be gone as well. So it won't go to the upside, right? That would put it right around this 53.75 structure right here. That'll be where the new point of control is when it finally moves, unless we build up a new structure somewhere else. We have a new VPOC from Friday. $53.61. So any move to the upside, and it lines up really close with where we closed Friday. So I'll consider that a double pivot when we finally get there. It's a nice little gap that we can focus on as a close when we eventually do make a run to the upside, which at this point, we don't have yet. Don't try to catch a falling knife, by the way, right? We're all looking for the flip point. There's a lot of examples where we get an exaggerated move like this and it flips around and goes back the other way. It's a classic one. And I've got some really great morning briefings where we had a negative day like this and it was really deep. And I pointed out examples like I'm going to do here in a minute of really negative days like this that flipped. And by the end of the day, they weren't so negative, right? It was like a big pin bar by the time we were done. We were 4.38% below the 10-week moving average. It's the same depth from the 10 we were at in the April low sell-off. Remember that 6.8% pullback or whatever it was? We were this far away from the 10-week then. If we go back to the bear market, we got 6 and 8% away from the 10-week moving average, but we're not there yet. And we're technically not in a bear market either. Notice the difference too between that being a confirmed bear market for a number of reasons, not just how far away from the high we were. The Fed was raising rates, right? There was a whole skew of things that made that a bear market. A lot of technical validations. In this, just being in correction territory, that 10% distance that we were talking about, that's just a correction level based on math saying we went this far from the high, we're in correction. But that doesn't mean that the market is in, quote, a bear market condition or a bear market environment. So we are at that distance where we would expect the market to pause, quit moving farther away from that 10-week, and either hold still while the 10-week comes to us, or turning around and going back towards the 10. Have we traveled too far, too fast, and does it owe us a pullback? Yep. And that's what we use this tool for, is to be able to answer that question. Most of the time I say, nope, but not today. We have moved far enough where we are due for a pullback, even if it's just a dead cat bounce. We are almost 5% away from the 10-day moving average. And even in the bear market of 2022, we didn't get more than 5 3/4. So, we're almost at the extreme of how far away from the 10 we would see before getting some sort of mean reversion back the other direction. One of the things that would assist with saying that we're in a real bear market is that everything gets sold in a bear market. But we can see the bottom down here, it's still green. Now, granted, healthcare is not very much green over the last 5 days, but it is still green. So staples, utilities, healthcare, they're still holding out. If we were in a bear market, even these wouldn't hold out, right? So whether it's a flight to safety or, a fractal rotation, a sector rotation, call it whatever you want, as long as these three are also holding up, then we're not in a bear market. And that's not the only thing that we would use to define a bear market, but it's a simple one. It's easy to see. All right, I mentioned other times where we've performed this maneuver. Yeah, this will work. Couple of really good ones. And I think they show up better on the SPX than they do the ES. But here's one of those lows where we broke structure and we dipped down really deep before running back up. We had some better ones than that, to be sure. It's another 2 really good ones. This one we'd actually gapped up first off of the low. Then we had the big pin bar, and then we rallied back up again. So another one. And if you look at it from the context of how many days, right? We were negative. It was just really negative, nonstop selling, fast, solid moves to the downside, breaking structure all the way, going and going and going. And then we got that day where we flipped and we ran back up. Sure, the next day was down, and it struggled down there for a while, and it wasn't done, and it eventually continued. But on that day, while it was crazy fast, steep, and headed to the downside, and everybody was convinced that it was just going to continue to crash and burn as it had over the last 4 days, We flipped and ran all the way back up, got through our own open, and closed higher than where we opened. So the point is, there's this statistic that says no matter how bearish we are, no matter how bullish we are, in the first 30 minutes of the regular trading sessions open, we can change direction with a 50% chance. It's a coin toss, a 50% chance that we can change direction no matter how bullish, no matter how bearish. It's another example of a 4-day sell-off and then a deep dump down and a rally back up. Another one here with a really great swing low doji bottom. And sure, it didn't, turn green and continue to go, but it did rally back up to where it closed very close to its own open. All right, so just cautioning a little bit of patience. Don't go out there and just, try to short this entire market, because even if we're going to stay bearish, we're very likely going to bounce very soon on something. The Bitcoin stuff and the semiconductor stuff is down the most, which, I mean, that kind of makes sense, right? SMH is down 9%. Bitcoin is down 19.5. The Mag 7 is down 25. The XXX semiconductors is down 25. But if we get out of those and just get into like a normal one, SMH, that's 9 to the downside. XLK Tech down 7.25. GDX Gold down 6.5, which still that Bloomberg interview just frustrates me. Uranium 6.25. Solar 5. Banks 5. Airlines 4.75. It would almost be easier just to say what's up, what's up, rather than what's down. And well, the only thing that really seems to be up this morning is the VIX and bonds. So we're looking at a VIX in 60. 2020, we had a VIX that reached into the 80s. And look, I mean, if you try to put the VIX on a historical time frame, you get misled. The formula has changed over the years. So this isn't the formula that we had in 08 and in 2000. It goes back that far because they used the new formula and they plotted that old data with the new math, but it was a different math then. However, the math we're using now is the same math we were using in COVID. So that's a fair example or a fair approximation of what the VIX is doing today, just looking at COVID zones. Don't take it back to the 08 area because that's not an accurate representation. This is a pretty high volatility level, all things considered, right? If we were still underneath 15 and had crossed above it, we would say it's just a pullback in the market, right? And as long as we stayed below 20, we could continue to say that it's just a pullback. Get above 20, but you're still under 29, then yeah, it's a correction. It's a deeper pullback. When we get above 29, then we start getting into a protracted decline and a secular bear market, but it's just a spike. The VIX is famous for these wild spikes that can change direction really fast. So until it closes up there at that level and it holds the level, it's just a spike. You can see back here, for an example, we had multiple spikes that put us above that level in 2022 and almost in 2023. It's just a spike at this point. Now, once it closes up there and it holds the line there, then we could say we're in a protracted decline. There's probably some real structural damage to the markets, and they're going to need time to heal. Notice with this move through COVID, it wasn't one big candle that shot us up there in a single day. It worked its way up there. When the VIX makes these massive aggressive spikes like that, they get sold off a lot. That doesn't mean that we can't stay there, because it's possible. Price can do whatever it wants, right? But until it does, this is just a spike. And a lot of these spikes match up with turning points in the lows, right? The highest point in the VIX oftentimes lines up with the lowest point in the S&P before we had a turnaround. Right? Something to consider when it comes to the idea that we could very likely flip here because we've really gone too far, too fast. All right, 100 is what we had talked about last week in TLT, coming up to this year-to-date anchored VWAP. This is where we started the year, right? January 2nd, 2024. And we sold off, and we've been working our way back up since April. Well, we're there, and we're getting into that December high. It's not 2023's high. It was just the high for December. $100 is a big round number that's hard to get through, as it was demonstrated in December when we spiked into it and failed to get through it. So getting above it is going to be hard. Keeping above it is going to be even harder, right? But first, we got to get to it, then we got to get above it. Even on the pre-market this morning, we can see we got near it. We didn't hit it. That was 99.91. Close doesn't count, right? Got to get there, get above it, and keep it. And that's going to be the hard part, keeping it. But we are back to January's levels, and we got there really fast. We are in backwardation too, I believe, in the VIX. That can be a little confusing for people that don't trade options. Contango and backwardation. Volatility is supposed to run in a curve like this. The farther out in time you go, the more time price has to move. And so volatility, the unknown, is higher out in time than it is up front. investors are more worried about the future than they are the present. Hurricanes, war, changes in presidents, all sorts of unknowns in the future keeps that curve in that shape, right? And that's what we call contango, because that's what the VIX is supposed to do. When it's not like that, when it is instead like this, where the front end volatility is higher than the back end volatility, it shows investors are right now worried about the market and that the current conditions are more concerning to them than things out in the future, the unknowns. And that's called backwardation. There's a lot of ways that you can see that without using futures products. There's a VIX 3-day, 6-day, 30-day, 6-month, and you can just type those in, right? Like you can just type in VIX3 and it'll give you the choice. There's your 3-month. Or you can type in VIX9 and you'll get something like a 9-day. All right, so you can stack these up looking at things close and things that are far away. VIX without any numbers behind it, that's a 30-day, in case you didn't know that. So you can do it without futures data. I like to just use the futures data, makes it easy. It's /VX, and then we've got the dates right here. So we've got August, September, October, November, right? And we could just scroll down the list. Unfortunately, it's not easy to see that, right? It's just all scrunched up at the top. The August VIX is at 34, and the September VIX is at 21 or 31. Let's just use that one, 31. And then we've got October at 29, November at 25, December at 23. So you can see how we're in the 30s and then it's dropping down into the 20s, right? It's doing that. That's backwardation, right? So one way that you can see this that makes it easier, I've done it before, I don't think I have one built right now, is you can use a watch list, right? So if we, let's just detach this one, see if I have it built. You can build a watch list and you can stick every one of those VIX futures into that watch list one at a time. And then you can see their price and you can see the inversion a lot easier that way. I think it's right there. Now I haven't been in here for a little bit to adjust it. So the ones that I have may be old. Yeah, they're 20, they're old. So we'd need to update it, but that's exactly how you would update it, right? You just go in and you would use the letters. So we're in the Q series right now. You would type in /VXQ and then /VXU and then VXV, VXX, VXZ, and even into next year if you want to. So that once you're done, you have this watch list of these futures and their price lined up nice and easy, showing you that backwardation. So that's one way to do it. And Thinkorswim being Thinkorswim, you can measure them against each other too. and just keep doing that until you get them all filled out. Or you can use the VIX 9D, VIX 3M, the VIX itself, which is 1 month. So then you got a 9-day, a 1 month, a 3 month, a 6 month, a 9 month. You could stack them up and you can see them that way as well. Either way, right? I broke it. Come on. So be careful. Look for the V bottom. Just remember, not falling doesn't mean rising, right? We can stop falling and base a lot like we did Friday, where we got a little more negative and then we just held the line for the rest of the day. We didn't rally back up. We could very well do just that. But that was the put wall that we were holding on to Friday. What do we have down here? Right? We don't have a put wall down there. Still, I would be looking for us to hold the line at a key level and keep that structure in place and or run back up. That it doesn't necessarily owe us a run, but I would expect it to stop falling. Keep your eye on the news. Be careful, be safe. I'll see y'all tomorrow.